We are at the start of a new financial year. President Uhuru Kenyatta assented to the Finance Bill of 2021 on Tuesday this week, giving life to several tax measures geared towards helping the government realize its 2 trillion shilling revenue target for the financial year that kicked off today. Notably, Kenyans have been afforded a sigh of relief, with the government shelving the proposal to slap value-added tax on bread, even as it widens its reach for revenue through excise duty on betting and gaming. Some may not be so happy to hear that. Julian Zamboko with those details.
On June 10th, Treasury Cabinet Secretary Ukur Yatani tabled the ambitious 3.6 trillion shillings budget, part of which included a raft of changes proposed in the taxation environment geared towards helping the Kenya Revenue Authority ramp up an extra 185 billion shillings in tax revenue. With the Finance Act of 2021 now available, Kenyans can know what to expect regarding changes in taxation. After much hue and cry, Kenyans can heave a sigh of relief as the earlier proposal to slap value-added tax on bread has been shelved. This follows the tidying up of the Value-Added Tax Act of 2013, which has seen bread deleted from the first schedule of the VAT-exempt items but retain it in the second schedule of VAT zero-rated items. Dealers in motorcycles can also heave a sigh of relief as the Finance Act of 2021 has thrown out the proposal to impose duty at 15% of the excisable value, implying the present rate of 11,608 shillings remains in place. The government has struck a delicate balance when it comes to excise tax on betting. Whereas excise duty has been revised downward from the proposed 20% to 7.5%, the Finance Act widens the net of services subject to the 7.5% to include gaming, prize competition, and lottery. Also widening its reach for revenue, the government will now impose a 25% excise duty on imported eggs, imported onions, and imported potatoes. The Act goes beyond revenue-raising measures and proposes administrative changes. Key among the changes are: employers who deduct employees' pension contributions but fail to remit the same have been put on notice. Trustees of pension schemes have now been empowered to appoint the Kenya Revenue Authority to collect pension deductions that have not been remitted by the employer and attach the employer's bank accounts where there is non-compliance. Further, the government will now be required to take any proposed double taxation treaties through the Delegated Legislation Committee of the National Assembly, in line with the Treaty Making and Ratification Act of 2012. This comes on the back of significant backlash on some of Kenya's double taxation treaties, with the Kenya-Mauritius DTA having run into headwinds in the corridors of justice in 2019. Julian Zamboko, NTV.